Let's turn to the housing market now. And the latest valuation read from Totality indicating it's grown for a fifth straight month nationally. What's behind that and what's to come? Anthony Landahl joining us from Equilibria Finance. Welcome back.
Very nice to be here.
All right, so lots of positivity. Certainly, I guess, if you're selling, that those prices are increasing. Not so perhaps if you're particularly a first home buyer, as affordability again becomes an issue. But is it the interest rate cuts that have been done so far and the prospect perhaps that we're going to get another one next week that are really boosting the market at the moment?
Yeah, as you touched on, the latest data indicates the fifth straight consecutive increase in growth. So that takes annual growth to about 3.4%. We had an increase of 0.6% in June. Coincidentally, the first increase was back in February. The market had lagged from November to January. And then in February, in line with the first rate cut, we started to see the market gain a little bit of momentum again. So I think what we're seeing on demand side is the interest rate cuts. There's also some government initiatives that are going to come into play. But those interest rate cuts are giving buyers extra borrowing capacity. And I think there's also a sentiment around further rate cuts to come, helping momentum. The other side of the coin we're actually seeing is a shortage in stock. Supply is down about 5.8% over the last 12 months, and it's down about 16% on the 5-year average for this time of year. What that's doing is it's creating some scarcity, which is also keeping demand and auction clearance rates quite strong. So I think it's a combination of the interest rate cuts, creating that borrowing capacity for investors. It's helping them manage cash flow, creating some opportunities for investors as well as some scarcity in supply. The market's growing and it's gaining a little bit of momentum again.
We're seeing that growth has been uniform in both apartments and houses, and also cities and regions.
Yeah, the regional areas over the last 12 months had quite strong growth, a lot stronger than the capital cities. But over the last quarter, last couple of months, the rate of growth's been pretty similar in terms of the regions and the capitals. The main capitals that are still outperforming the rest of the capitals are Brisbane and Perth, and interestingly Darwin. Brisbane, Perth and Adelaide have been very strong over the last 12 months. Their growth rate's close to 10%. The rest of the capitals around about the 1 to 2% growth rate. The regionals are tracking similar to the capital cities now. So we're seeing fairly strong growth across both those areas. In terms of the housing market and the units, it's actually still quite regionalised. Some of those less affordable areas, particularly for housing, the market is still a little bit subdued. But interestingly, some of those areas where we might have a surplus in units, we're also having a subdued market. For example, there's some concentration of units in some of the major capitals, and they're struggling to get traction. But generally speaking, more affordable areas, whether it's a house or a unit, are seeing some good, strong growth.
Now, in terms of affordability, you talk about obviously with interest rates falling, it increases the capacity to borrow. But at the same time, if those prices are rising, it's sort of a double-edged sword, isn't it?
It is a double-edged sword. Annual growth's at 3.4%. Some are predicting with the momentum that may come in the market that the growth rate will grow to 5 or 6%. So we'll see a double-edged sword. 1% off the cash rate, which we may not be far off with a rate cut on the radar next week and then possibly another one. That might add $80,000 to $100,000 in borrowing capacity. A lot of it is sentiment though, where a lot of buyers are now able to go, look, I can go to this market or that market. It is then against a backdrop of a growing market. So a lot of that affordability can potentially get eaten up by that.
What activity are we seeing among investors at the moment?
Yeah, investors, there's two sides to the investor coin. There's the existing investor that have really been struggling with cash flow. We're seeing a lot of existing investors get a little bit of relief from these rate cuts. We had investors selling properties that they were trying to hold during that period of rate cut.
Would they be tempted now that prices are moving higher, despite the fact rates are coming down, to sell? Would they be more motivated to sell now, do you think?
There are some that might be looking at capturing that capital growth, but most investors are taking a longer term view. The market has been a little bit more subdued. They're in a stronger position to hold their property. They might be looking to leverage into another property. Investor credit flows are up, and investor activity is generally up. Investor credit flows are up close to 15% over the last 12 months after a very subdued period of when there was that growth rate through the pandemic in both housing prices and the interest rate. So investors are back. What we're also seeing for investors is on the commercial side, investors are looking at, obviously with the interest rates falling, they're looking at where do they put their money, and we are actually seeing a bit of a U-turn around some of the office space. The corporates are looking at bringing staff back to work. It's been a fairly subdued market in terms of some of the office and retail space, and we're actually seeing some uplift, and there's talk of some uplift in a recent KPMG report, particularly in the commercial office space and retail space, with investors looking at some opportunities now with rates falling.
How's the competition among the lenders at the moment? Is it worth shopping around both in fixed and variable?
Yeah, there's some good competition. Fixed rates aren't overly attractive. They're 1 or 2 basis points from the variables, but we're starting to see some good competition. And if people aren't getting the rate cut from their provider, there are some good opportunities out there for people.
And outside of property, what are you seeing with small business loans at the moment?
Small business lending's been difficult. Credit appetite and lender appetite has been difficult in some sectors, particularly for working capital and cash flow requirements. There's a lot more wariness I'm seeing from credit providers. They're drifting much more towards secured lending. We are seeing a lot of inquiry around working capital requirements though, but we are also looking at a number of clients looking at purchasing properties, but we're seeing the appetite amongst the credit providers, particularly for working capital requirements, is getting quite difficult.